Hey everyone, Michael Manaskanian here. Thank you for joining me for the live underwriting session in the Wealth to Real Estate School community. So what we're going to do now is I'm going to spend the first couple minutes reviewing a deal that my business, Coast to Coast Vets, with my business partner Adam Catledge, a deal that we're currently have under contract. It's a pretty sick one, very unique, and we're currently raising capital for it. So let me start with screen sharing. So this is a Coast to Coast Vets property. This is a pretty awesome one. So this is a 7-unit commercial property in Puerto Rico on a beautiful, beautiful beach, just blocks away from the beach, as a matter of fact. There's cave exploration. They've got like this huge surf competition there every year. It's pretty awesome. And the reason why we really love this one is not only the debt and the financing, but also because it's 3 units on the bottom, which are commercial, and 4 units up above. 3 of them are active short-term rentals, and the 4th one's kind of just used to store stuff in there. Could definitely be used to drive income. So we have proof of concept for the commercial as well as the above in regards to short-term rental. We know that through some improvements to furnishing and management, we can really crush it and make it even more profitable. But the best part is we were able to structure this as a 0% seller finance deal. So every single monthly payment is going directly towards the debt. And the 3 units down below, the commercial units, they cover the entire debt expense. So basically, all of the short-term rental income up above is, I guess, a bonus in a sense. So we're not dependent on that to at least cover the debt payments. So that's awesome. And we're very conservative in our underwriting for the short-term rental side. And then another cool feature, if you're familiar with Jerry Norton, he has provided us a lot of assistance in regards to connecting us with the right people. So we have leveraged that as much as possible to just get connected with the right people and do things the right way. So high level overview, we're looking at raising a total of $120,000 for this deal. We plan on closing at the end of the year or end of the month. And if you know us, we don't just raise the bare minimum capital needed to acquire the deal. What we do is we raise the acquisition costs, we raise rehab and furnishing costs, as well as the reserves. So whenever we raise capital for a specific property, we're always going to take on more than we might need to in regards to reserves, so that if there's an issue, we have the money set aside for maintenance, capital expenditures. Let's say the property's sitting vacant for a little bit, there's some carrying costs, all that kind of stuff. And then, as I mentioned, the exit strategy is 3 units are commercial, 4 of them are short-term rental. Our overall purchase price on this 7-unit mixed-use property is $820,000. Like I said, the best part, though, in my opinion, is the debt financing terms at 0% seller finance. Every single monthly payment is principal. So if you're familiar with the way that we capital raise, we offer 2 private money lender options. The first one is 8% for 12 months. And with that 8%, really what you're paying for is education. We show you every single thing that we are doing with the property, how we acquired it, how we negotiated it, why we structured the way we did, how we underwrote it, how we're going to close on it, manage it, all that good stuff. Plus get you some education on previous properties we've closed and future ones. And that's really for the person who wants to recreate what we're doing while generating pretty solid returns on their money instead of letting it sit in the bank. And then we also have the standard 12% silent PML opportunity. So we'll probably dive into that deeper in these next. Yep. So there you go. This just shows the breakdown of the expected returns at 8 and 12%. And then we have a 12-month hold, but we are always open to our private money lenders that want to stay longer in the deal. Just to clarify, this is very common with these types of transactions. There is more than enough cash flow each month to pay the private money lender their interest. What there typically will not be is enough capital or enough cash flow from the property to pay off the principal amount of the debt, which is totally fine for us, because what we do is at the end of the balloon, we offer our private money lender an option when it's that 12 months is up. Do they want to continue collecting their 8 or 12% returns, or do they want to get out of the deal? And as long as they give us 30 days notice, we can easily find another private money lender to come in and replace them. Because what we don't want to do is sell the property or refinance the great 0% seller finance loan that we have in place. So we just basically refinance the second position prime money lender with someone else. And typically what we've observed is people are willing to even take a lower interest rate return after those 12 months because now it's less risky. There's more proof of concept. So yeah, we have all that going. So that explains kind of the exit on the back end for the private money lender. So what we're going to be doing to really drive income on this property, as I mentioned, we're extremely conservative in our short-term rental income, but it's really highlight the features to attract the guests that are specifically coming to this location. Super touristy, go all in on the surf competition, the beach, make it really just like a luxurious coastal stay to increase the revenue. We're going to modernize the interiors, highlight various unique features of the property, improve the aesthetics, including the photos, which definitely need to be, they're like mom and pop style, plus really add the fourth unit into the mix instead of letting it be a waste in a sense, because it's just kind of a storage closet. So with that being said, we can actually go into the numbers now for everyone here. Very separate than what we'll share with our lenders, but let's get into the actual numbers. So I will, at the highest level, show you, screw it, let's just go right into it for you guys. The way I have this underwritten, right? It's a seller finance deal. The way I have this underwritten is, let's zoom in for you all. We have the rental income at 2,000, which is what we are paying. That's the same as the seller finance loan. That's the commercial piece downstairs. We have $4,500 or $1,500 per unit as short-term rental. Please disregard that long-term rental. Sometimes we cheat and do short-term rentals in this when there's multiple units. And then we, in our pro forma, we're also adding $650 a month in short-term rental income, which is super conservative because that is what one of the commercial units down below said they would be willing as is to take the property or take that unit as additional space for them. So we have the rental income as well as the market rate rental income. And once again, we're super conservative on the short-term rental income projections of this property. Overall purchase price with a very low down payment. Yeah, go for it, Winnie.
What kind of vacancy are you accounting for?
So usually what we account for is 60%, or it really depends on the market specifically. So if I go, let's see what we have in our short-term rental. So we have 67% at $200. I'm not 100% sure this piece is right. Adam did the rental income projections, my business partner right here. He just put in the 1,500 as a conservative estimate. If we were to, what we can do is take that 1,500 times 0.6, right? Let's just assume 60%. Let's just assume 50%. So 50% occupancy. What is the average daily rate? So that's, well, I guess we could just do that divided by 15. So we can do 7. We could do equals 1,500 divided by 15. So it's $100 a day average daily rate stay, right? Over a month time span at 50% occupancy. Okay, so it's really conservative on the low end. We've definitely spent a lot more than that when we go to Puerto Rico, and we're definitely not as close to the beach. But great question. We will do a legitimate short-term rental underwrite at some point. We'll go through AirDNA, get comps, all that good stuff. What I really want to focus on after is how we can underwrite sub-2 and seller finance deals. Pretty straightforward if no one has a deal for us to underwrite together. So, yep, the monthly payment. So if you know me, the way we like to negotiate is we don't focus so much on interest rates and all that. We focus on the monthly payment, and then we reverse engineer to see at what interest rate, well, actually at what amortization or term can we get 0% to still satisfy the monthly payment. That's a super pro tip on if you're negotiating seller finance deals and they are more focused on the payment, which is what you should be talking about, as opposed to the so this will actually be as opposed to the interest rate. That is how you can really drive and get really low interest rates because you're solving their problem. For our income and expenses, we actually have profit and loss, which is very useful and helpful in regards to determining what the costs are going to be for the property. Although we will self-manage, we're still accounting for our 15% property management fee. When we're using prime money lenders and self-managing, this is really just business income for us. So it's even more conservative in that regards. Plus a low vacancy, maintenance, and CapEx, because vacancy is already accounted for in this rental income projection, plus the maintenance and CapEx. The property's pretty turnkey, and we're going to be spending a decent amount of money improving it even further. And then what we actually are doing is raising the capital up front to build our reserves, our war chest up front, just in case something does occur quickly. And we have the balloon. It's a 15-year balloon, so really no concern in that regards. And then when we look at the income, expenses, property management, reserves, we're looking at a net monthly cash flow conservatively of $1,527 a month. Yep. And then so at annualized $18,000 a year at a cash on cash of 15.3% if we were to use our own funds, right? And then I also like to account for, if we didn't have reserves, what does the cash flow look like? So if we didn't have the vacancy, maintenance, and CapEx, because realistically, when you own an asset, it's going to be somewhere between that worst case scenario of using all your reserves to the best case scenario where if you don't have to use a single dollar of it. I like to make sure that my cash on cash is ideally over what has to be over what we're willing to pay at PML. And then the cash on cash without reserves closer to 20%, ideally over 15%, but closer to 20 is solid. And then in the calculator, we do have the using other people's money tab, which really shows you if you were to use a private money partner. Let's just do year one, actually. If you were to have it's like I'm messing that up. If you were to utilize a private money partner and they're the ones to bring all the funds, you can edit the ownership percentage and the cash flow percentage that they would receive. And then you'd get pretty automated, what are all of their returns and would that justify for them? So for example, if they own 32% ownership and 32% cash flow, year one cash on cash is 8.74% with an ROI of approximately 23.5%, because of the fact that they're getting the appreciations of the benefits of debt pay down, appreciation. If there was interest payments, they would be getting, the tax write-offs associated with that, depreciation. And this is assuming everyone is taking a 28%. That's the income bracket that they're taking the deduction from. So you can adjust all this as needed. In this scenario, we're looking at just the private money lenders. And, we're always going to verify, does it make sense with 12% or 12% or 8%? And succinctly, that is on this tab. So these are all updates to the calculator that are coming for everyone who's paid for it. Oh, I think I'm frozen a little bit. It's okay. So you'll see the property, you'll see the long-term deal analysis. What the cash flow is. So this is higher because this is at the pro forma, right? Because we will be executing the pro forma. This is assuming at the pro forma rental income. So you see the cash on cash is much higher. All the other benefits, so our total ROI, if we were to use our own funds, but in actuality, we're going to use private money lenders. If we were to use a private money lender, our cash flow, what does it go down to for the year? And as long as this is over zero, you're always going to have infinite returns as long as you don't have to put any more money into the deal, as well as some of the debt info, because people love to see that, even if they're PML and they have not the debt doesn't matter to them. They love to see if you lock up a really great deal. Similar concept for the private money partner breakdown. It extracts the information needed to present succinctly to your private money partner. Does this deal make sense for both of you, right? And it highlights not just the year one ownership, but over the long term, what do the ownership returns look like? Any questions before we actually do some? Yep, go for it, Whitney, before we go into some actual underwriting other deals.
I don't want to be the broken record with all the weird questions here. But curious how you negotiate what that ownership percentage is.
With our private money partners?
Yes.
So it's ultimately up to us. I'm going to tell you this right now, because of the fact that we can raise capital at 8% and 12%, Our goal is to be very fair in the ownership, but we cannot give up so much cash flow that we're getting them a cash on cash return higher than we can get as a PML. So in actuality, the cash flow, let's say we were going to go PMP route. And this for the full sake of transparency, because if we can cover 8% to a, or 12%, to a PMP, why wouldn't we use a private money lender? It's easier in every capacity, especially all the administrative work associated. So what we would do at minimum is get this closer to 6 to 7% return for our private money partner. And the ownership, it really depends on a lot of things. So let's start with the cash flow first. So we're going to get that to, let's say, 25%, be like 20%. All right, so we'll do like 23% of the cash flow. So they're around over 6% cash on cash return for them, which is solid because then they also get the benefits of the ownership, right? They get the other benefits to make it much better. So then for the private money partner, what percentage of ownership? We typically start with a third. It's kind of my business partner and I, we all just split a third of the property. But depending on the entry cost to the purchase price, that's a big calculation. Depending on, are we walking into some equity? Are we walking into, well, really, that's it. Equity, the debt terms are really important. Or do we have phenomenal debt terms? Because if this was at 10% interest, we would be losing a lot of this debt pay down benefit. So there's no right answer. I know a lot of people start when they're starting off 50-50 to everyone. Everyone splits everything 50-50. I think that's fine when you're starting out. And that's why private money partners tend to be more of a beginner capital raising strategy. We still do offer it if a deal really requires it for one reason or another, but it's not our preferred route to raise capital. Really, private money lending is, especially when you understand that you can refinance a private money lender with another private money lender in a year. You don't have to sell everything off to buy that property. So that was, or to pay off that private money lender. You can just replace them with someone else. And that was a big reason why we went private money partners initially, until we realized, wait, there's plenty of people that want to lend now. Once a private money lender has been paid out, they definitely want to take that position. But it took, I guess, practice and proof of concept to come to that realization. So yes, lots of variables. People start at 50-50 because we bring the deal, we operate, we do all that, and they bring the capital, right? They bring the capital, we bring the deal, negotiate, operate, all that good stuff. So, that's kind of where it comes from. I wish there was a straightforward answer, but typically what you'll see is most people start at 50-50 and then adjust. With the way we do it, if we're going to do a PMP, we're going to make sure that the returns do not, on cash return, right? They do not exceed our private money lender returns because they're getting so many more benefits than what a private money lender would be getting. Otherwise, why would anyone be a PML? I think it'd be a PMP with 20% returns, and so that's kind of the explanation there. Any more questions? I'm happy to go over any of this. Raz is a master capital raiser. Maybe he's got something for us. All right.
Oh,
So
I'm not sure about that.
No.
Go ahead.
All right, have a
I
deal
joined late.
that
I
they'd
don't
like
want to
to
interrupt.
underwrite together. Right. And just as a heads up, right, you all can go to, well, you found me on school, so this should be pretty easy. Actually, you can go to school. Not sure I'm signed in. It's okay. Because, wow, look at all these people. All right, everyone's got the word wealth in there now, huh? All right. Let's see. I thought it'd be easier. Oh, there it is. Hey, we're just starting out, so we're growing. You can go here and you can get access to the calculators here. Just going to link you to the same thing, or just directly on my website, michaelmnat.com. Made it real easy for you. And then you can look up, yeah, we accept. You can download my conventional finance free investing calculator, creative finance free investing calculator, my paid. This is conventional finance calculator. This is a seller finance specific, subject to specific, and then the ultimate creative finance calculator, which has basically everything. If I were you and you were to get one, I would just get this one. But the cool part about these two is they have some scenarios that are unique to just sub two or just seller finance. But if you've done any creative finance deals, you know the majority of them end up having a mix of creative or high. They're typically hybrid between subject to and seller finance. But that's where you can download a ton of free or two free calculators, and then if you want to buy any of them. Also, it's linked right here. If you haven't checked out, if you haven't played around with it yet, you can download all these. All right. Anyone have a deal they'd like me to underwrite? Otherwise, I can pull something up.
I'm down. I got one. Seller
Yeah,
finance.
please. Hey, Jose, how you doing, buddy?
Doing good, man. Good to see you.
All right, let's do it. So
What
this
kind
is not the one linked there. This is my Coast to Coast Vets one, but I'm going to update the paid one to basically this one, so everyone will get access for the paid calculator to this one, and the free calculator. We could do the free one, but let's just do the paid one for now. All right. Are you comfortable sharing all the info then? Or do you want to withhold like address and all that? I don't know if it's under contract or not.
It's not. We're right at the like end stages of it.
Do you want to wait and just we skip that piece and go into the others?
We're only a couple in here. I think we will be okay.
Okay. So go
Um,
for it. We'll start from start to finish.
Cool. Address is in the chat, and it's unit 312.
All right. Are we going to be pulling comps up as well?
You could, I guess, to do a full
I mean,
image.
do you have them?
I don't have any.
You don't have any. Okay. But
comps
you're in
because-
the final stages of negotiating. You don't have, well,
Just wanna pull up real
is this, what's the situation? Kind of give us a high level. Oh, wow. Look at that right on the beach.
quick. Yeah. So it's a seller that he's kind of tired of the property. He's moved on. Listed it with an agent. Agent hasn't gotten an offer in a very long time.
Hmm.
So I threw out a seller finance and they're open to it. I told them it's not going to be the number they like. And I threw out a low down payment and they were open to it. So
Do you know what the unit is?
312. 312. Right?
So 3x3, 1351 square feet. Okay, so open seller finance. So 3, 1351. It's pretty small for a 3x3.
Right? Yeah, I think so too.
Right. It's not one of those gonna have a second dining room, it's gonna have its little living room and all that and kitchen, but all right, how do you want to underwrite this as a long-term rental? I mean, it's probably short then, but
STR.
we'll start with this and then we'll adjust it all right after just to kind of go through the exercise. So we have 312. I always highly recommend. Okay, for the test. I always recommend hyperlinking at least the Zillow listing, so it's nice and easy to reference later.
Mind if I record this so when I buy the calculator, I know how to use it?
This will be in the school, so you can you'll have forever access.
Awesome.
So 3x3, 20. Okay, so let's pull up the property. So what we're gonna do is quickly look at a few long-term rental comps. So we're gonna go on Rentometer. If you're not familiar with Rentometer, just a data aggregate tool, nothing crazy, but it gives you a rough idea of the rental income based on historical rents. So it says the median income. Oh, wow. Yeah, look at that. I would verify that you can short-term rent there. I would assume, but I would verify that.
I did with HOA. They do daily rents, and
awesome.
The rent I was getting on Zillow for long term is 3,000. So
yeah, so this is showing because the average or the mean is higher than the median. I mean, something is skewing it up, so there can be properties that are renting for more than that. But let's take the median and let's put it into. You don't have to use any of this, right? But it's Rentometer. All right, let's do BP rental. So we'll do bigger pockets as well. And then what we'll actually do is some real comps. Bigger pockets rent. Whatever. Oh my God. then don't use my address. All right, I forgot the address again. Copy. Boom. Yeah, I'm saying boom, but nothing's happening. All right, so let's get the address. Let's try it again. Okay, 29.40 a month, and we see very high, so there's a lot of rental comps there. This is a 3-bed, so that's definitely gonna help. So let's try that with that. It should go up. That's so weird. It went down, huh? So maybe there's not a lot of 3-beds there. And honestly, I don't even care about any of these comps, right? Do we agree that the beach ones, especially if it's beach facing, who cares about these ones that are blocks from the beach? We only care about the ones that are actually on the beach for this specific type of property. So we have, which one's that? This one? So 3150, 3850. Because look, if you go here, what's this one? Well, shit, that's 3250. That's still pretty high too.
But the 3850 is significantly larger. Yeah, it's 3-bed, but it's a lot square footage wise.
It is a lot square footage larger. Not a great comp. 3,500, 3x2, 1980. See, that's more realistic for they probably, these could be penthouse style, honestly, but that's a lot of square footage for a 3x2 as well for a condo. Let's see. These could be houses for all we know. And then what we'll actually do is get some real comps. Oh, there's a little hospital there too. Cool. Yeah, I'm cool with, let's go with the 3150 because it looks like it's in the same building, 2-bed, 2.5 bath, 1,200 square feet. Similar square footage. It'll probably rent for a little higher, but I'm cool with that for long-term rent for right now. It's not really the main strategy, but that we'll go with. Oops. What we'll do is take this link, copy that, hyperlink that. Okay. All right. So you want to get into the seller finance terms? We can go on Zillow and get more long-term rent comps, whatever. We'll just stick with 3,000 for now so that we have time to actually analyze this deal and see what we can do. So purchase price.
Got him to, what was this, the list price?
List
460.
price was 475.
460, I got him to.
And you're sure they own it outright?
Yeah.
Okay. I mean, they did advertise seller finance. It just, so they just
Mhm.
rolled money into it.
Yep.
All right. You said how much? I'm sorry.
460,
460.
30,000 down.
30. Okay, so what you can do is you can do a percentage in the calculator, right? If you do 5, it'll do that. Or if you have a dollar amount, just overwrite this code and then just go here. And if you want another percentage, put equal 30,000 backslash or divide the purchase price. So then you have the percentage. So it's around 7% down payment. No loan that you're taking over. So then therefore the whole remainder is 430,000, right? The whole rest is seller financed. Interest rate,
2.
nice, good interest rate. 30 years, I'm assuming. So your monthly payment on the seller finance debt is 1,589.36. What is this? Oh, so because there's no sub 2, so this is the loan amount that you're taking over sub 2 to figure out what the seller finance piece is. You have to get rid of the monthly payment they'd be taking over by just going to the very right, the original sub 2 loan terms. You could either change that to 0 and that'll change everything to 0, or you could overwrite the actual number here, but just change that to 0, solves everything.
And the
All right.
correct is more closer to 2.2 because it's like 1625, something like that.
2.2% interest.
Right. Mhm.
Okay. Do you have any information on the taxes and insurance, or is this something you need to quickly gather?
We'd have to estimate because they had homestead for a while.
Yep.
So their taxes are nothing basically, but I estimated 300 a month. They're
So-
around 3.
Okay. Did that come from anything in particular, or?
PropStream. PropStream has it at around 2,600, so I just overestimated a little bit more.
Okay, we're not gonna look up county records and do all that right now and look up the county. Let's stick with yours. It says at 2387, $238,000, the taxes were 3,300.
Double it.
So it would probably be a lot higher if the assessed amount is dollar for dollar with what they assume it is. A lot of the times it's a percentage of that, like 60% of the value of the property is the tax assessment amount.
Mhm.
If it is the homestead exemption, they might be 100 or 200 or whatever thousand off. Without going into the county site, we're not going to know. But I would feel much more comfortable doing a much higher property tax assessment payment than 300 a month. But we can do that. Just know that it may not. We'll just put 3,600. I think it'll be higher, so I would definitely vet that in regards to taxes. What do you have for insurance? We can just do a quick estimate too.
It's in the HOA.
It's covered in the HOA, the insurance?
Yeah.
Very convenient. All right,
Yeah.
so we'll change that to 0. What is the HOA cost?
785.
All right. And then what utilities are included with the HOA? Water, trash,
Everything, electricity.
everything is included? That's freaking awesome.
Mhm.
Right now, as a long-term rental, we're gonna say 10% private management, which is standard. We'll update the other section after for short-term. Reserves will keep it standard, 8% vacancy, 10% maintenance CapEx. I think this would be very, very, very low vacancy. Just to clarify for anyone who's newer, 8% vacancy translates roughly to 1 month of the year the property is sitting fully vacant. Okay, that's where that 8% number comes from. You're estimating that for 1 full month, the property is going to sit vacant. And what I also like to account for in that vacancy is even if it's not a full month, there's still turnover costs that may not be covered through the security deposit. So that's kind of where some of that money is getting saved for as well. And then maintenance and capital expenditures. Your maintenance is like you got to send a plumber out or electrician to do some, quick touch-up work. Capital expenditures are when you're saving for a new roof, appliances, flooring, whatever. The HOA is going to cover the big costs like a roof or maybe windows or maybe not the windows. It depends on what's in the bylaws of the HOA, but there's still costs associated with maintaining the appliances and all that. The nicer the more recent it's been remodeled, the less you have to worry about. That was the common area. I was like, this looks so. There you go. So it's got some updated appliances. Well, it's all black appliances, a little outdated, early 2000s cabinets, it looks like. Fridge is outdated. So, you'd probably end up putting $5,000. If you're going to short-term rent it, you'd want to upgrade the appliances. Get $5,000 to remove that, get new ones, haul them away. We'll talk about that in entry costs. Decorate the property. Let's see that view again. It's like it's intentionally a little misleading.
It's parking lot view, so it's on
Yeah.
the end building.
So phase the opposite of the beach. It's going to be tremendously important when you're doing your short-term rental comps, like insanely so. We cannot compare it to the beach facing ones.
Yep.
Yep. Okay, I see. Because people will pay a ton of money for the beach facing one to wake up to that, So this is actually somewhat a little bit more comparable to some of the further away ones, just because of the fact that you don't get the beach view, but you're also literally on the beach when you walk out. So that's nice. All right. We said Florida. Oh, it doesn't really matter, but let's see what it does say for Florida insurance. So for that price point, $3,352. So maybe you are, 300. Oh, well, I guess we didn't say that for insurance. Never mind. Disregard what I just said. That was taxes. All right, let's just analyze it now. We have our long-term rental income projection. We have our debt as well as our expenses and reserves. Oh, is there a balloon on the seller finance loan?
10 years from now. Told them it could change.
Perfect. 10 years from now. Okay, so okay. So just to give you a heads up, this is the cool part about this calculator as well. In addition to the amortization schedule, which shows you every single month, how much each payment is gonna cover, how much equity you're gaining, what the, principal, what the loan balance is, all that stuff for as far as you wanna go. I've also coded it so when you set the balloon term here, it will tell you how much principal have you paid over that time, how much interest have you paid over that time, what the balloon payment amount will be, what the loan amount will be at that point. And then you can highlight to the seller, well, this is your total profit as a negotiating tool. I know you think you're selling it for whatever. In actuality, you're going to get this $511,000 in addition to the down payment you provided up front. Right? So that's a nice feature there. So let's just see how this looks as a long-term rent. Oh, let's go into the down payment to seller. That's already pulled from there. Arrears or liens. There's no debt in place, and I doubt they have any liens. So there's nothing there. Is there an agent involved? I would assume so.
Just like that, 2.5.
2.5, and you're covering it or splitting it?
I was splitting it half and half.
Okay, so 2.5 is being split. So actually it's, well, I guess I could do the math, but we'll just say equals, 2.5 divided by 2, 1.25%. So you want your entry costs. Rehab and furnishing costs, we're going to put this at 0, and I'll explain why later, because we're going to underwrite this as a short-term rental shortly. Closing costs, you guys splitting it?
Yes.
See, this is the fortunate thing about seller finance. The seller is motivated by a dollar amount, monthly payments, something else. It's not that they have literally no freaking money at all to be able to move on from this property. On a subject to deal, you're typically going to cover the agent commission. If there's no equity, you're going to cover the agent commission, the closing costs, all that stuff. In this scenario with the seller finance, the seller has the equity. You're giving them money. That's all their money. They're not paying off a loan. They can then cover these costs, or a portion of these costs. So are you guys splitting it 50-50, you said? Okay, we'll still estimate, because you're gonna have to create the note and all that. I mean, we'll just say half that for now. Closing costs, I don't know what other features and costs might be associated in Florida. Let's just put 1.5% in regards to like whatever extra costs there are for closing. What I always account for as a buyer is my admin and reimbursement costs that my lender will need to pay me back at closing. For example, I pay for transaction coordinator up front. I pay for the LLC formation, the inspection. We use Gator and we use EMD fund. We use people to fund our earnest money deposit. We have to pay them back their amount. For me, that translates to approximately $5,400 of reimbursements for me as the buyer. In your scenario, let's look at it from the wholesaler perspective, right? Or are you going to be the buyer?
That's what I'm deciding right now.
Let's put $0 for now. And just assume, whatever. That's part of your closing costs.
Mm-hmm.
If you're a wholesaler or you're paying a wholesale, there's this assignment fee. For us as buyers, we have an acquisition fee because of the fact that we have a lot of overhead to cover our CFO, our COO, our asset manager, our bookkeeper, all the software and services that we use. So that comes to us up front to cover our overhead, but we don't charge anything for any of those benefits for our partners or lenders throughout the process, I guess. Throughout the property ownership, they just get all the benefits of that without being billed for it. So that's kind of allows us to keep the cost for the overhead. This we'll just put at 0 for now then. Carrying costs, I like to approximate 3 months of reserves for basically all your expenses is what this is. We can do more or less, but I just start with 3 months there. We can put 0. And then we can make this, a little more realistic as needed after. But this is pretty much what a wholesaler is going to tell you, right? 30,000 agent commission, assignment fee, closing costs are going to say it's for you to figure out because it really is a little more nuanced. So looking at it from this perspective, income at 3,150, expenses at 2,718, property management at 315, and reserves at 567. You're cash flowing negative $450 a month. So obviously your cash on cash is negative. If you didn't have the reserves, you'd be at $117 and 2.67%. If you were to operate this as a long-term rental, you could say, hey, I'm going to self-manage. I don't care. and I don't care about reserves. So your returns are a little different, right? But you could say, I'm gonna self-manage, this works for me. It's a local property, that's the route I wanna go. Or, as we mentioned, this property makes more sense as a short-term rental. Do you have income projections for it as a short-term rental?
No, not yet. I did basic data Rabu stuff, but I wanted to see you run through it.
You want me to run through? We have less than 9 minutes. Do you want to just give it for the sake of this for now?
So it would say, yeah, AirDNA was saying 340 a night, 65% occupancy, but then I
60
started
what?
65.
Okay.
But I started looking at more details and it was around closer to 280 rate. 280.
Okay. And that's the shitty part about short-term rentals. And really, especially, you got to make sure that you're doing ones that are very similar interior and exterior, and this one in particular, because the ones facing the beach and the ones on the front lines are going to make significantly more income than the ones that are not. Because you're adding the view and the proximity to the beach. Those are two huge things. So you really want, just like any long-term rental comp, you really want to look at the properties themselves, not just the numbers that it spits out. So our PITI and HOA, that's already included. There's no additional utilities in this instance except internet. Are you going to cover internet? Or is that in HOA?
It's in HOA.
Jesus. Okay, so no extra expenses. This is one of those unique times where actually a long-term rental is almost stupid, because the fact that in a long-term rental, you're not covering all these extra expenses. If you're already paying for it in HOA, it makes a ton of sense to midterm or short-term rent it out, because you don't have those additional costs that you would between long-term and short or midterm, because you're already covering it anyway. You could pass on the HOA cost to your tenant. That's something we haven't mentioned, and I don't know how they rent it out in this condo or in this apartment complex, but I assume that is what they would be doing, is passing off the HOA costs to the tenants, or at least a portion of it, like back billing them somehow. Your short-term rental property manager is going to be more expensive. I don't know that specific area, but the standard is between 20 to 30%. So right there we have 25. Just as more rule of thumb, 15% for midterm, and then 10% for long term. It's like 15 to 20% for midterm, 8 to 12% for long term. And then the furnishing costs. So are any of the furnishings conveying? Not that they're tremendous by any means, but
No, it's not good.
yeah, I don't even mind to be like rude, but like you wouldn't want to use these anyway. I actually have this in a property in Alaska. That's so funny. I was exact table. That's Alaska. It's a 4-unit, not a luxury beach one. I would stick with the 25,000, because you're going to spend 5,000 on appliances at least, replacing all those. You're going to furnish each bedroom. Each of the 3 bedrooms are going to take you a few grand. Let's say 3,000 roughly. I would say 25 is pretty solid based on my historical knowledge of our properties for what the cost would be to furnish a property like this, especially if you want to do it really nice, add, games and chairs and all that kind of stuff for them to use at the beach, which I would say, you're not doing any major renovations or construction. You're just, right. I don't think you could throw some LVP over the top of the flooring. It's tile and carpet. Man, it's definitely dated inside. You could spray all this white, get this resurfaced. The bathroom honestly looks fine. The vents look good. So if you want, what I would include, separate your furnishing costs from your rehab. And if you wanted to on the higher end, you could say clean flooring and bathroom updates. So cleaning is going to be around $1,000 to get really nicely cleaned. You're going to do the flooring, which is, what do we say? How many square feet is this?
1,300.
1,351. So we'll do plus 1,351 times, what are we paying now? $3 a square foot, which includes install and remove, maybe $3.50 a square foot. I mean, so 3.5 plus the bathrooms, we'll say, are 3 bathrooms times. I like to link things here if possible. If I have the numbers here, I like to link to those instead. Times, let's say you're gonna do like really nice, I mean, you're gonna do a lot for $2,000 a bathroom, like a lot. You can do a lot for that much. So now you're maybe $11,729. That's not for you as the wholesaler to worry about. That's for someone else. That's the end buyer to worry about. But as the end buyer, let's say this is really nice flooring, bathroom updates, and cleaning the property, general rehab, because nothing seems substantial that needs to get done here. Is this necessary? No, you can rent it as is. But let's say you go that route because it's a short-term rental. Your furnishing costs are still in that $20,000 to $25,000 range. Based on this, now your cash on cash return is 11.8% with a $881 monthly cash flow. For me, that's not a deal because I like more than that. But now you need to see, is the additional renovations that you did in the furnishings, can you drive the income more than this? Whether it's higher daily rate or higher occupancy percentage, or is there any way you can reduce the expenses? Well, you really can't because you're only paying your seller finance, taxes, and HOA. If anything, your taxes might be higher, is what my estimation would be. Your property management. So this what can you do? Shop around for property management, right? Get a property manager at 20%. That's going to make all the difference. Or even self-manage. That's very tremendous if you can, especially for a year or two. Just that alone would solve this cash crunch. And the reason why the short-term rental cash on cash return is so low is we have $25,000 of furnishings that we're adding here. Could you go a little lower end? Sure. It's not like it's this huge space. 1,300 square foot is not a lot to furnish. You're going to have your common living room, your kitchen. You can deck both those out for less than $10,000. If you're the buyer, you can do what I do, which is I'm willing to eat into my cash flow to get 0% financing on furniture. I'd even overpay for 4, 5, 6 years of 0% financing on furniture to reduce my entry costs, even though that's going to eat into my cash flow. For me, that's way better. Same reason why you pay a private money lender 12%, right? It's because my entry costs are now lower or 0, whereas my cash was getting eaten away, but that's fine. That's a very worthy trade.
Really,
you know, if we
realistically,
did,
80%, the occupancy.
what was that?
Yeah, the occupancy is realistic, like 80.
80?
Yeah. I don't know if that makes a lot of a difference.
That's going to make a massive difference because you're saying it's renting for 15% more of the year than we thought.
Mhm.
That's going to make a huge difference. So really hone in on that based on specific comps. Because this is Florida and near the beach, it should be high because Florida is a lot warmer and people are going to the beach all the time. So this should be high, but remember, Florida, depending on where, is pretty saturated in the short-term rentals that they have, right? So it could be that there's a ton of short-term rentals, and so I would be cognizant of that because now you're getting to a bidding war with each other where everyone's reducing their price a little bit. And unless your property is above and beyond the competition, whether it's a bigger house or more beautiful or beach facing or whatever, all you can compete on is price then. So you might be, all negotiating each other down to reduce your rates. All right. So there's all this. So yeah, obviously that's going to make a tremendous, whoops, no, it's not supposed to be that. So that would make a tremendous, I don't like to mess with rental income and comps when I'm trying to underwrite. I like to get it for what they are and then understand what is negotiable, what can be negotiated, right? On a seller finance, the best thing you can negotiate is the down payment. It's already only 7%. So it's going to be tough to reduce it much further, but you can try, and you can say, hey, I'm going to be improving the property. I've got $12,000 bucketed to improve the property, as well as another $25,000 to improve the furnishings. Maybe you can use that as a tool to negotiate the down payment. But remember, when you negotiate the down payment down, your loan is higher, so your monthly payments are higher, so it's going to eat into some of your cash flow. I would say the return on cash is almost always better that way. Let's say we did 20,000. Right now we're getting back to some of those original terms. Your cash on cash is higher, not tremendously so, but it is higher. Yeah, I guess the ratio, the difference between the lower down payment relative to the higher or lower cash flow, lower down payment and the lower cash flow, it doesn't make a substantial difference, but oh, don't know what I just did there. There we go. I'm gonna leave it alone. What else could you potentially negotiate? You can have them cover the agent commissions and closing costs. Say, hey, I'm giving you all this equity, use that money to cover it. I wouldn't. You could try to negotiate the interest rate lower to increase your cash flow, but really it's your entry costs end up being really high, almost 100,000 between down payment, rehab, all that good stuff, assignment fee, and the furnishing cost. So, there's a couple options there. Any specific questions? I know Whitney did have a question.
Yes, my comment was, or question was around the average daily rate. Knowing that it's a place like Florida that has such seasonal like highs and lows kind of, are we looking at an annual daily rate?
Yeah, usually all of that is annualized,
Okay,
right? Everything is annualized instead of seasonally adjusted. Otherwise, you need multiple models and you just
Yep.
Run it for the whole year that way.
okay.
So that's where
Just
the occupancy rate really comes into play. Because like it's going to be, for example, I have plenty of properties that are 100, like virtually 100% booked depending on the month. And then other months it's like 20-30%. Someone's barely coming in. And the rates are definitely different.
right.
So yeah,
Okay.
these should be your averages for the year.
Okay.
Yeah, Ross?
Yeah, so kind of related to the entry cost. So you said it's about 100K, right? Assuming you don't have the 100K, right? You just have 20% of that. How would you update the calculator to account for like a private money lender?
Perfect. So in the calculator, you have using other people's money section, right? So we're going to click that and you can say, okay, well, if I did a private money partnership, let's say we go the 50-50 route, right? Oh, this is as long-term rent. So let me change this to STR. So now all the numbers are updated for short-term rent in here and all that. Oh, and this is at the pro forma. Yep, that's good. 23,308. Okay. ADH. Sorry, I'm just running this real fast. Annual, monthly, seller finance up to vacancy. I found a flaw. HOA is not in here. HOA is not in here. So for the time being, it should be in here. You can put it under here. I'll fix that. This is why it's good. That's why it's good that I build my own calculators, because then I know what to fix. So we can include 14. Okay. I'll deal with that after. I don't want to fix it right now. But let's just say for the sake of this example, if you go 50-50, here's the return for your private money partner, right? They bring in 100% of the cost. So you're 89,000, right? It's updated for the short-term rental. And then you give them 50% ownership, 50% cash flow. These are their returns and these are your returns, right? You get infinite returns because you're bringing none of the money. Or you can see, does this thing work with private money lenders? Let's say at 12%, 0% points, you'll still be cash flowing $1,048 a month. Obviously, it's disingenuous because we don't have the HOA costs. It'll be closer to like $300 as a short-term rental. So you can use either the private money lender in this scenario or the private money partner because it cash flows and it cash flows substantially. Are you asking if you were to fund a portion of it and they funded the remainder, what that would look like? I don't have that modeled in here because we do all or nothing instead of like funding 20,000. That's pretty easy though to say, you know, let's
No,
say you're
yeah,
gonna,
that's just a detail. I was just curious, like if you were
well,
to
hear me
bring.
out. Let's say you're gonna fund 25,000 and they're gonna
Mhm.
fund 64,000. Here's what your cash flow would be, and then you would just say that times 12 divided by your 25,000. We don't need parentheses, but for the sake of making it digestible, you'd be at 62%, right?
Mhm.
Does that make sense?
Yep.
If you're just funding a portion of it yourself, you just need to account for what the cash flow would look like with the PML costs. Yeah, so we don't do that, but that is definitely possible, and just expect, yeah, that your returns are gonna be really high, but you're just gonna have to refinance them out at some point. If anything, I would use all other people's money and then pay them back at the end of that balloon. But it just depends on what you think you can do. 62% is a great use of your money, so you know, it really depends on the person. All right, cool, y'all. I'm calling it. I've got a meeting. Anything else? Any more questions? Anything like that?
Thanks, Michael. This was great.
Oh, of course. Yep. And as we do more of these, they'll get even better and easier. I have a whole form for everyone to fill out, so it'll be even easier to get all the info. And then we can actually do some more comping of short-term rental income, long-term rental income, like really get into the weeds. I'm realizing an hour is not a lot of time, but yeah, so just stay connected. Check me out on Instagram. That's all I ask. That's it. Thanks, y'all.
Thank you.
Bye.